Hello traders, and a warm welcome to this video on the differences between the Forex market in relation to the commodities and the stock market. And what I really want to do in this video is just highlight some of the differences, if you like, between the foreign exchange market and these other markets. Now, no way, shape or form am I saying that the Forex market is better than any of these. That's not my goal here. I don't believe that there is such a market that is better or worse than another. It's just that every market is individual, has its own set of differences, and that's absolutely fine. What I want to do in this video is really just give you a strong understanding of the differences between the two, some of the plus points of trading in the foreign exchange markets, and maybe not some of the best points about the commodities and the stock market. And this again is just to raise your level of awareness as to what some of these core differences are. So let's start by looking at the foreign exchange market. So one of the best things about the foreign exchange market that doesn't exist over other markets is certainly the foreign exchange market has a greater deal of liquidity. So that's the first one. A lot of liquidity. What does liquidity actually mean? So let's take an example of an auction room at a property show, let's say. So there's several properties going on for auction, and the auctioneer has, let's say, 300 people in that room all ready to bid for a property. Now, you'd probably agree with me that if the auctioneer has 300 people in the room, rather than if he has 3 people in the room, it's going to make a big difference in terms of the actual price that that property will go for. That's what we mean by liquidity. Liquidity is a larger number of players in that space. And with the FX market, certainly $4 trillion a day are traded. That's $4 trillion. $1 trillion, just so you all know, is $1,000 billion. And $1 billion, of course, is 1,000 million. So that's a lot of dollars that are traded across the market every single day, and it's an amazingly big market. So there is a lot of liquidity. That's good for us because it obviously gives us some advantages which the other markets don't share, which I'm going to talk about on that side over there. The other thing that the foreign exchange market also enjoys as well is no insider trading. So what do I mean by this? So some of you may have heard of the times which certain stocks have been manipulated in terms of prices, or people have found out about earnings reports earlier than they should have, and then you get this huge gap in the stock's price and this massive surge suddenly, and someone obviously has an unfair advantage. They class this as insider trading because some trade secrets about a particular business or a company were revealed before they were meant to and before they got out into the public domain. So this is insider trading, and the foreign exchange market, just because the raw size of it doesn't have any insider trading. It's not possible to insider trade the foreign exchange market just due to the sheer size. So that's one of the other things that it will enjoy as well. And that no insider trading also means there are a couple of other added advantages onto that as well, such as there are no gaps in the market as well. You get a nice, clean, clear move because of the amount of liquidity as well. So that's the second advantage. And a third advantage of the foreign exchange market in relation to, let's say, the stock market is low dealing costs. So the dealing costs to actually trade foreign exchange are actually very low. And what I mean by that is they are literally cents, pennies. They're not much at all. So you place a trade, pretty much the only thing you're paying for is the spread, which is the minute difference in between the broker's bid and ask price, or the price at which you buy at, which you can actually then sell back at, is one of the costs you have. And then let's say you hold overnight, then there's an interest rate that you have to pay, or actually can be paid back to you depending on which currency you're trading. For example, the interest rate in Australia is quite high at the moment. So if I were to buy Aussie dollars, so let's say I were to go long Aussie dollar, and I were to buy Aussie dollars and sell US dollars, I would actually be paid an interest rate into my account actually for doing that. But obviously if I were to do the other way around and sell Aussie dollars, because the interest rate is so high there and the rate for the US dollar is not as high, I would actually pay an interest charge as well. But again, depending on the position sizes you're trading, this is a very, very minute cost in relation to, let's say, for example, the stock market, where if you buy a stock and you physically want to hold a stock in a company, you're going to pay things like dividends, dividends will be paid to you, but stamp duties you'll certainly have to pay. You'll have to pay tax on your earnings from that stock as well. whereas the foreign exchange market has options where you don't even need to actually pay any tax. If you use UK spread betting laws, then there's no actual taxable pay. Now, if you're not in the UK, then obviously you can't necessarily capitalize on that, but there may be an alternative in your country. But certainly in the UK, they have vehicle spread betting, which is under UK tax law, certainly tax-free. So the foreign exchange market actually saves on a lot of these costs, and this is what actually gives it low dealing costs. So the profit that we actually end up making here in the foreign exchange market, we actually get to keep a large bulk of it. Now, this is very important, and those of you that have run a business in the past will know this, that when you make a net turnover of, let's say, 3.5 million in a year, if your expenses were very high, then regardless of the fact that you've made that 3.5 million, it's not really of much use if your expenses were, let's say, 2.5 million. Your net bottom line profit is not so great. So obviously, if you can keep your costs down, not just in this business, but in any business, then you're on to a winner, and the foreign exchange market does enjoy this as a benefit. Let's talk about some of so these are maybe some of the plus points of foreign exchange. Let's talk about maybe some of the not so great points about the other markets. Now, again, just to remind you, I'm not in any way, shape or form saying that these aren't good markets to trade. As I said, we already do trade the commodities markets anyway, and we're looking to actually diversify some of the strategies that we've actually built into the stock market as well. So everything has its pros and cons if you know how to work with it, and that's the reason for this video. I really want to educate you all into what the key differences are. So some of the maybe not so good points about these markets. First of all, the stock market certainly has gaps inside it. So one of the things that the stock market does, you will see quite a bit of, are gaps. And the reason for that is, generally speaking, a lack of liquidity, or sometimes, as I said before, insider trading. Now, that can work for you and it can work against you. If you're obviously long on a stock and you've bought when this amazing news comes out, then that can work well in your favor. Now, if, for example, you were short on the stock and it went against you and it gapped up, you would actually be taken out of the trade, maybe if you're day trading it, way above where you'd expect to be, and that would have a heavy impact on the capital that you initially decided to risk, especially if you're leveraging your money. So, of course, if you've bought and you're holding the stock, not so much of an issue because you're just going to hold for the long term. Obviously, it will dent that investment. But especially if you're day trading, gaps are something that you really need to be aware of. The next thing that's different about both the commodity and the stock market is that they're both not 24-hour markets. So this is something else to note as well. They're not 24-hour markets. So with the foreign exchange market, of course, we have got the capability of trading around the clock. So if you have a global team, then of course you can take advantage of the moves across the different sessions. I've spoken about trading time zones in another blog video. You should certainly be subscribing to our updates if you'd like to get informed of all of these amazing content that we're sending out. Do subscribe to the videos. But this one thing, that this market is definitely not 24-hour market. So you can't trade them at any given time that you'd like to. So that's important to know as well. And the last one, so what is this? Lever representing, of course, a lever is representing leverage. So leverage is something that you will struggle for in these two markets as well. So with the foreign exchange market, generally speaking, if you're opening up with a broker account, you can get up to a leverage of 1 to 500. So for every dollar that is being traded, you're able to control $500. That's a large amount of leverage. Now, we don't necessarily use that all the time, but it's an option on the foreign exchange market. But certainly, if you're trading in the commodities and the stock markets, that is not an option. And that's something that means that you have to invest even more capital to be able to make a better return. Now, generally speaking, with commodities like gold, people generally tend to invest rather than day trade because that is more of a long-term movement, especially with gold, because gold has very large price corrections. And if you look at a gold chart, you'll see in the market some huge price corrections. And of course, once again, it can work for you, it can work against you, but again, it's something that you should be aware of. Generally speaking, people do tend to invest into the gold market rather than day trade it. So I hope that's clear, and I know that that's added a lot of value. So that's pretty much it from me on this video. Until the next time, as we always say, stay disciplined, follow your plan, and trade like a master. Bye for now.